At the same time, you have AI, and AI investment is increasingly translated into real economic growth in the US and in technology-focused emerging markets such as Taiwan or South Korea.
So welcome to this month's Market Outlook podcast. My name is Lauren Tace, and I'm happy to be joined by Aymeric Forrest from our investment team. So Aymeric, if we can dive straight in, this month on the markets, it feels like it's a story of two forces. On the one hand, we've had some risks from the conflict in Iran that's still ongoing. And on the other hand, there's also been some opportunities, it seems, from AI. So could you maybe start us off with some market highlights from the past month?
So in May, markets continue to navigate indeed those two competing forces you just highlighted. So the geopolitical tension in Middle East and what we can say extremely powerful tailwind from artificial intelligence. Equity markets were generally positive, led by global growth stocks and emerging markets. They were both up around 8% in May. Technology and AI-rated companies continue to benefit indeed from those strong investment trends. And stocks and regions more exposed to the energy shock underperformed. So, for example, Europe. Although Europe was still up 4% for the month, but it's 4% behind the other regions. The dollar was stable, and bond markets were fluctuating because of the situation in the Middle East. So initially they were challenged. They delivered then small positive returns ranging between 1.5% and 0% on the escalation in the region. And if you look at oil price, indeed, for the month, it dropped 12% on renewed optimism for a deal between Iran and the US. So it at the moment kind of stabilized between $90 and $95 a barrel.
Thank you. So it seems like these themes have started to drive a clear divergence in the market performance. Is that correct?
Yeah, absolutely. So there's obviously a divergence in performance. I gave you an example with Europe. European equities. They were leading the pack in February. If you remember, they had very strong January, very strong February. They're still up year to date. They, in euro terms, they're up 7% or so, but they're lagging emerging market, US and Japanese equities. So emerging equities, for example, they're up 24%. Japanese, they're up 16, US are up 12, again in euro, in order to compare. And all that is driven by the sector and style exposure of those indices, both influenced by the impacts of the conflict, of course, and of AI investment on the economy and on corporate earnings.
So you've just touched there on the economies. Can you maybe delve a bit more into the economic impact of all of this?
Yeah, so obviously if you have higher oil and gas prices because of the conflict, they put pressure on inflation. Yeah, and they may also weigh on consumer spending, business activity, particularly in Europe and Asia. They both rely extensively on Middle Eastern energy imports. So at the same time, you have AI, and AI investment is increasingly translated into real economic growth in the US and in technology-focused emerging markets such as Taiwan or South Korea. So, for example, Taiwan GDP was revised up 9% year on year. And in the US, if you exclude the software, the hardware contribution from tech, and if you exclude the contribution from the US government to the first quarter GDP growth, what is left is an economy that would have contracted by minus 0.3%. So whilst instead it grew by 2%. With the help of technology. So we can't ignore that. And recent business surveys also suggest this divergence is becoming more visible, with activity holding up better in the US than in Europe.
Thank you. And how is this reflected in actual company profit growth or earnings growth?
Mhm. So it's a bit the same story as on the economic side. So there's a strong on the tech and weaker elsewhere. So if we look at corporate earnings using the first quarter results that were released just last few weeks, uh, those have remained remarkably resilient across most sectors. And obviously, they have grown exponentially in some, such as communication services and IT. So the first quarter earnings season was probably one of the strongest, if not the strongest, since the fourth quarter of 2021. That was obviously driven by AI infrastructure, semiconductors, because they benefit from the investment, and related technology. So while technology remains a major contribution, we also started to see earnings expectations improve across a broader range of sectors. That suggests that if geopolitical tension ease and energy prices stabilize, earnings growth could become more broad-based over the coming quarters. In the second quarter, it's probably unlikely to be the case, but it's something we will have to monitor, especially if there is, as I mentioned, a stabilization in the Middle East conflict.
So just going further on that theme, a few months ago we spoke, and it seemed like geopolitics was the main dominating factor of all market themes. Is it still playing a key role? What's
Yeah,
the outlet there?
yeah. I mean, obviously, as I just mentioned, we can't ignore AI, but we can't ignore also the geopolitical. This is the most important risk for investors at that stage, and it changes constantly. Yeah. So although a ceasefire has reduced immediate concerns, this ceasefire is very fragile. There are ongoing uncertainties around the negotiation between the US and Iran. It's not something we can foresee, forecast, or intend to be honest. Um, but our central scenario still remain that tensions gradually ease and energy market normalize over the second half of the year, simply because there's so much at stake. However, if disruption to shipping routes and energy supplies persist for longer, probably until September, October, that could put further pressure on inflation, growth, and financial markets.
So does that mean that even the current winners could still come under pressure in such a scenario?
It's possible, yes. The market is obviously currently pricing a gradual stabilization as well. They relatively align with our central scenario. If that outlook deteriorates, we could see, as I said, a pause or maybe a broader correction. But technology and AI-related stocks, they may still continue from powerful structural growth drivers. You know, AI investments not going to stop. But they're not completely immune. Some elements, some components rely also on raw materials, yeah, and oil derivative products could be one of them. Um, of course, they're probably at the end of the chain. It may take some time. They may be prioritized as well. But critically, how the situation evolves um, from September and the start of the fourth quarter. That will be key to assess the severity of such risk because of the management of the supply and of the demand for energy and energy-related products.
Thank you. So over the past month, other big news is that we've had a new chairperson of the U.S. Federal Reserve confirmed. Can you maybe just tell us a bit more about the challenges that central banks are facing in this environment?
Yes, so Kevin Warsh is joining the Fed. That's not at an easy time, especially given
Yeah.
the implicit mission he had to ensure that rates remain attractive for the consumer. But generally, these situations makes it a sort of difficult balancing act for central banks. So on one side, you have higher energy prices. They're pushing inflation back above comfort levels above the target. So we're going to probably have a print above 4% in the US this week on Wednesday. We're probably going to have, and we have seen prints well above 3% in Europe. On the other hand, you have AI-driven investment that helps growth and productivity, but only in some sectors, in some regions as well. Markets so far have completely removed expectations from an interest rate cut. That's what we've seen at the start of the year. And now expect 2 rate hikes in the Eurozone and probably 1 to 0 rate hike in the US. Why 1? Because the latest non-farm payroll data were quite strong. So it's the state of the employment, the job market in the US is still resilient, still robust. Of course, those are data, they can fluctuate, but it's still robust. Whilst economic growth could slow faster in Europe, but the Fed has a dual mandate. They need to consider both employment and inflation. While the ECB, they probably don't want to be behind the curve, and they focus more on inflation risk. And this is why they're more likely to hike compared to the Fed. But it's clear that it's going to be a difficult balancing act for those central bankers going forward.
And then finally, in this very divergent world, how have we positioned our portfolios to make the most of the opportunities on the one hand, but also to protect us from the risks that we see?
Yeah, so diverging world, diverging exposure as well. We need to indeed take risk in this environment. So generally, we remain constructive but selective. So within equities, we continue to favor US emerging markets and technology-related sectors. It's simply where earnings growth remains the strongest and where AI adoption continues to create opportunities. We acknowledge, because of valuation being stretched and positioning a bit stretched as well, that a pause may be granted after such strong performance, but we cannot ignore their strong growth potential. We were even surprised by the size of those opportunities. We remain more cautious on Europe, so it's not a surprise based on the discussion we just had, simply given the greater sensitivity to energy prices and lower exposure to AI-driven growth. Within fixed income, we're also selective on credit, prefer global high-yield bonds. We also have added some emerging market hard currency debt over government bonds. Government bonds remain under pressure from both budget deficit, but also the upward inflation pressure we just discussed, and pressure on monetary policies. And finally, we continue to see value in diversification through exposure to the US dollar by keeping our exposure unhedged. So that's going to be quite interesting going forward to follow those divergences and to ensure that our portfolio remain resilient in this environment.
Brilliant. Thank you, Aymeric. That was very insightful as ever.
Thank you, Lauren. Thank you, everyone.
If you found this episode interesting, please visit our website for more of our team's insights, including previous podcasts and our series of investment basics articles. You can find us on Apple, Spotify, YouTube, and all leading podcast apps. Just search for BNP Paribas Asset Management Updates for AXA and subscribe to our channel. And if you like what you hear, then please do rate our podcast on your chosen platform. Thank you again.